You spent over a decade mastering the art of diagnosing patients. You can spot subtle clinical signs that others miss. You make life-altering decisions daily based on meticulous data. Yet right now, there's a critical diagnostic error happening in your own life. Medical training taught you to examine patients thoroughly, but you're likely missing the most critical self-examination, the financial vital sign that most physicians fail to monitor. Many physicians who can recite complex differentials from memory struggle to quantify their own monthly expenses within a few $1,000s. This blind spot isn't just costing you money, it's costing you years of your life in clinical practice that could be optional instead of mandatory. I will be the first to admit I was financially ignorant throughout medical school and much of my residency as well. I really didn't know my numbers, and I would pretty much just wing it when it came to budgeting and how I would spend my money and save it each month. I really didn't have a good feel for what was coming in, what was going out. I certainly wasn't investing or growing wealth at that point in my career or my life. I was basically falling into a trap that many physicians find themselves in. A high income, but really no wealth building strategy. It wasn't until I really sat down and actually took stock of my financial vital signs that I realized how much this blind spot was costing me. Just like proper diagnosis requires accurate data, financial independence requires knowing all of your financial numbers, how much you're actually getting each month in the door and how much is going out each month in terms of your expenses. To really track your numbers, there are two main personal financial statements that I think every physician should be familiar with. The first is your net worth statement, which is also called a balance sheet. And then the second is your cash flow statement, which is also called a profit and loss or P&L. You can think of these in the analogies we've been using as the equivalent of your patient's vital signs. If you're not monitoring these regularly, you're practicing blindfolded. So if we look at each of these, they are essentially just a snapshot in time of your financial health. Each of them changes month to month and year to year. So it is important to be updating and keeping track of these periodically, as they can give you the complete picture of your financial health. Your net worth statement is a snapshot of your financial position at a specific point in time. The formula is pretty simple. Net worth is equal to your total assets minus your total liabilities. Assets are anything that holds monetary value or something that could potentially produce some income for you. So that includes your cash positions, that includes all of your investment accounts and various investment vehicles, and then that also includes any property that you own. Whereas liabilities are the debts and obligations that you owe to others. So some of the big ones would be things like student loan balances, mortgages you owe to the bank, and credit card payments. As physicians, we do have some unique blind spots here. It's pretty easy to undervalue practice equity if you are an owner or partner in a practice. You can overlook the true impact of massive student loan balances. Or you could fail to account for future tax liabilities that might come with some of your deferred retirement accounts. Shifting gears now to the cash flow statement, this tracks the money that's moving in and out of your accounts over time. The formula for this is total income minus total expenses. For physicians, some common income sources would include clinical compensation, call pay, maybe speaking fees, and any investment income you might be receiving. Common expenses might include all of the usual categories you would think about as your typical living expenses, plus any professional expenses like licensing fees, CME, and malpractice insurance, assuming those aren't covered by your employer. The power of tracking this every month is that you'll identify any spending leaks and understand your true savings rates, which I'd say the vast majority of people underestimate or really just have no idea anything about what this number actually is. And that's a big limitation, because if you don't know how much you're actually saving, how are you ever going to know how much you can safely invest so that you can grow your wealth and fund a healthy and happy retirement? A common misconception is that income and wealth are directly related to one another. However, income is really what you earn in a given period of time. It's essentially a rate. Whereas wealth is what you own minus what you owe. It's a quantity. While they are related, people with higher incomes can have higher wealth. That's no guarantee. So the wealth to income ratio helps you understand this relationship. It's calculated by dividing your total net worth by your annual income. Many financial experts suggest a healthy target would be 10 to 12 times your annual income by your retirement date. While a physician earning $300,000 sounds wealthy, if they have a negative net worth due to significant levels of debt, their wealth to income ratio could be negative. Meanwhile, someone who's earning less, but they have substantial assets, could have a much higher ratio. Another important metric to look at is your financial independence ratio. This is found by using your monthly passive income divided by your monthly expenses. When this ratio reaches 1.0 or higher, you've achieved financial independence. Essentially, your investments are generating enough income to cover your monthly expenses. At this point, you can practice medicine because you want to and not because you have to. I know what you're thinking. There's not enough time in the day to do all of your work, take care of your chores, take care of errands, let alone track all of this information on an ongoing basis. However, I do think that there is some value in setting aside some time initially to really run through these numbers and establish your baseline. Then you can use either a spreadsheet or an accounting software, something like a Quicken, something that can help you automate this process so that you can track it on an ongoing basis. I think the systems that work the best are the ones that you're going to actually use and aren't too complicated or going to take too much time such that you'll just give up on them and forget about them. Probably once a month or maybe once a quarter at least would be a good interval for you to be tracking this information. That can be pretty simple. You can update your account balances, review your income and expenses, and then you can start to look at some of those key metrics. Is the net worth going up or down? Same with the cash flow. And is your financial independence ratio moving closer to financial independence or further away from it? You might also start to see some problems that might pop up. Maybe there's some fees that you keep noticing on an ongoing basis or some subscriptions that you forgot about. And this gives you a chance to adjust and fix some of these problems before they continue to compound over time. Knowing your numbers is powerful. It can really transform how you approach both medicine and your money. When you have clarity on your financial vital signs, you can practice medicine because you want to, not because you have to. You can make investment decisions based on data and not just on emotions. And you know exactly when you've reached financial independence. And because of this, you can have less anxiety and more clarity about your financial situation. If you're ready to start monitoring your financial vital signs and you want to collaborate with other like-minded individuals, then I invite you to join our private Facebook community where we discuss these topics in much more depth. In my next video, I'm going to be breaking down the fundamentals of mortgage note investing in a way that will make sense to your analytical physician brain. Make sure to subscribe so you don't miss it. Remember, monitor your financial vital signs as carefully as you monitor your patients. Your financial well-being depends on it. Thanks for watching, and I'll see you in the next video.